waiting to see if anyone is online. I'm going to put something in the chat. Hi John, how you going? Where you I'm trying to figure out how much lag I've got. We'll wait a bit of time just to let everyone join. Yeah, okay, that's excellent. Who else we got joining? Hi Sam, how you going? Hi from South Africa, excellent. I'm not gonna try to pronounce your name. Sorry, I'll embarrass myself. I'll probably wait, maybe give it another 5 minutes, and then we'll get started. Got quite a range of experiences here. From the survey that I did. So it's gonna be interesting because there's some people who are quite advanced and some people who are kind of starting out. So I'm gonna sort of have to balance it a bit, but yeah, we'll get through it, and of course can always do another session if people want. Anything before I start that like people think of what they want to see covered, you can put it in now, so I'm prepared for it. And I'm not going to be covering specific companies. That in case anyone hopes that they're going to get stock tips, they're not going to get any stock tips, unfortunately. All right, we've got Michael, Warwick, Eric. Nice. How you going, guys? Let's just test my transition. It's quite a slow transition. So if you ask your question, you can expect me, it'll probably take me about, I feel like it's 30 seconds to answer, so just bear that in mind. It's not as low latency, it's not as low as I thought. Okay, we got 26 people, so I want to see some more introductions in the chat. People, where they're coming from, how long they've been investing for. All right. I think I'm going to get started because we've got an hour and there's a lot to get through. So I'm just going to dive in. Anyone can go and watch the recording later. So yeah, so there's heaps to cover. Okay, so we're going to be covering valuation. I'm really excited to talk about this because we've completely just overhauled our analysis of valuation on Simply Wall Street. So there's going to be, I'm going to go into that in detail. Hopefully there's something for everyone here, even if you're quite advanced or even if you're just getting started. So first of all, let's get into it. So Simply Wall Street, just to remind everyone, we're here to be the #1 place that individuals like yourselves can go to build a successful stock portfolio. And it's really hard being an individual in the stock market, and that's why I started the company. I want to make it easy for people like yourselves to succeed, and we truly believe that that's possible. So we want to give you the advantage. Now let's talk about valuation. So the first bit I'm going to start with is something that I think most investors learn over time, but when you're just starting out, it can feel very confusing, which is basically that growth and value are actually the same thing. And you're like, what? That's confusing, but actually I'm going to talk through it now with you and explain what I mean by that. So this is a really important concept to get your head around, and don't worry, it takes a bit of time. And that is that the price of a company, the share price or stock price if you're in the US of a company, is simply the markets, like the stock market's forecast of that company's future, and specifically future earning. But just to keep it simple, you can just think of the share price as being a forecast of the future. And let's go and look at a example. So the share price is the market's forecast or the market's narrative. So if we use a classic car as an example, and I hope you like the classic car I've used here, you give a shout out for anyone who recognizes that. But a person has a classic car and they put it for sale for $5,000, right? And you've got two buyers from the car. Buyer A thinks the car's actually going to be worth $10,000 in a few years' time. Buyer B actually thinks it's only going to be worth $4,000. Okay, and what's important there, very similar to the stock market, is each person has their own valuation for that car, right? Of course, buyer A thinks it's undervalued, buyer B thinks it's undervalued. But the question that I put to you guys is, so what is the price of that car? All right, please put that in the chat. What is the price of that car? Now there's a big delay here, so it's like a 30-second delay, so I'll wait, and I'm expecting it to come flooding through. So what would the price of that car be? $5,000. Amit's on 5,000. I want to get 2 more answers. All right, 6,000. Right, so I see here what's happening. So Amit's going with just the price that the person's putting it up for sale, right? And Marco's going for the kind of like the average. And it's interesting, it's a kind of a trick question because in this case, the car actually hasn't transacted yet. And so that's a fundamental difference between price and value. Price is something that is kind of set, right? It's actually, in this case, would be set by the exchange. So when something is transacting, that is what the exchange is using to set the price, right? And I won't go into the detail of that, but technically it's a trick question because there is no price because there's been no transaction yet. But the value is something else, right? The value is what, buyer A, buyer B thinks they've got a value. So it's kind of a trick question. Anyway, all I can say is that car is worth a lot of money because it's a great classic car. Now, this is a kind of annoying concept to get your head around because the share price is always future looking. And what that means is that investors are always trying to preempt each other on what's going to happen. So it's a sort of this concept of preempting again and again and again. And that's why you have the share price moving around so much for companies, because all of these different scenarios, when there's news, when something changes about it, the market is going to change and react, and it's all reflected in the share price. So even though these things happen in the past, right? Even though, a stock misses earnings, a CEO departs or whatever, and those are historical events, what they're actually doing is they're just impacting the market's view of the future, right? And again, it can be slightly hard to get your head around that. Very quick example, bit out of date. Small company at the time, like Square, the CFO departs, and you have a huge crash in share price. And really, what's that saying is that the market is the market wants that person to be CFO. It's a big part of that company's future. As soon as that person leaves, they're all revising their forecasts for that company. And finally, just for this part, it's really important to understand this point, that your valuation for a company, and it's not, don't think of it as a number. Your valuation for a company really should be driven by your narrative for the company or your view of the future of that company. So I won't go into that in detail, but that is a really important one to remember. Okay, so we're going to look at 3 ways to value a stock. I'm going to swap over to the platform now. Okay, it's going to take a bit of time to change over. And so now I've swapped over to Simply Wall Street. Hopefully people on the you guys recognize this. And just I'm on Meta, right, or what used to be Facebook. I'm in the company report. So to get here, I can just come here and I can just type Meta at the top in the search. And where I'm actually going to start, I'm actually going to start in the overview, and I'm going to start here, which is the fundamental summary. So I know we said we're going to talk about valuation, but this fundamental summary is a great place to start because it gives us the simplest snapshot of the market cap, so the total value of the company compared to the earnings and the revenue, and that is exactly what's driving these ratios, right? So we've got a really simple snapshot there of just to visualize how those two ratios compare. And remember, that is exactly what the PE and the price to sales ratio is. And then you've got a waterfall here, which again, we're going to be talking about valuation now, but this is just such a good place to start off when you're looking at a company, because it gives you a very quick snapshot of what that business looks like, right? We can go straight from the revenue all the way down to the earnings, and it's, we've got that for every company. So that's really powerful. So I'm in the platform. I haven't yet gone to the valuation section yet, but I'm just saying that the fundamentals summary is a good place to start off for any company that you're looking at. Okay, so back to here. There's really only 3 ways to value a stock, right? And those are comparing it to others, right, which will be known as relative valuation, a bottom-up type valuation known as intrinsic value, right, and using experts, which isn't really a valuation as such, because actually the experts are also coming up with their valuations, but you're just relying on experts to come up with that valuation. Now the good news is that Simply Wall Street is going to cover all of these, and that's what we're going to go through today. I'm actually going to change my, oh no, this is good. Okay, so I'm going to use an example for a property. So this is more for the beginners to get their heads around, but example for a property would be relative valuation would be something like saying, hey, this 3-bedroom apartment in this neighborhood, wow, this is a great price for this 3-bedroom apartment because I'm comparing it relatively to other 3-bedroom apartments in that neighborhood. The bottom up one, and you have to sort of imagine this, but imagine I'm going to buy a property, I'm going to rent it out. Bottom up would be how much rent might I earn in the next 20 years and what's the value of that going to be today. That would be kind of bottom up version. Or based on experts, where I might just say, well, I'm using an agent and my agent tells me that this is a great buy, so I'm just going to go buy this property. So that's one way to think about it. So the equivalent for a stock is the first one, again, comparing it to others. Usually we use ratios for those, and we're going to talk through those in a bit. So we usually use ratios to compare because it's a standardized way of comparing. It's very easy. With the ratios, it's important to choose the right one, and then you need to choose who you're going to compare it to. And generally speaking, you'll compare to a small set of companies, usually known as peers, right? So companies that are similar to that one, that's important. Or you compare to a broad set and you say, well, broadly, these are the same companies. So usually you might compare to the industry then, or some kind of broad set of companies. And there is also one other way to look at a relative valuation, which is known as a justified or fair ratio, which is quite novel, and we're going to talk about that a bit later. The bottom-up one, which is often known as intrinsic value, is always done using a discounted cash flow. So you're basically forecasting cash flows or earnings out into the future, and you're trying to work out the value of them today. We'll go through that in a bit. This is a slightly more complex way of valuing a company, which is why for the average investor, they usually don't go to this level of detail, and it's very dependent on the inputs. And finally, of course, you've got the analysts, you've got the I'm using quotation marks, the experts, and they will set price targets for a company. So, and the good news is it's all in Simply Wall Street. So let's get into it. Okay, so I'm back in Simply Wall Street. I'm going to swap my video over. Yeah, how cool is that? Now, sorry, I've swapped it over so you can see the full report, but I have blocked out the I have gone and blocked out the table of contents. So sorry for that. Okay, so I'm on Meta, and I'm actually going to go navigate, and if you guys, log into the platform, you can follow me when you're doing this, or you just watch. I'm going to navigate to the valuation section. I can get there just by clicking on the table of contents here, or I can actually click on the snowflake as well. And so the information that I've just gone through with you, those different ways of valuing a company, the good news is that is exactly what is here. So that is exactly what we've tried to do with this new analysis, is we've tried to look at all of these different factors that you can use to value a company, and that is what's actually driving the snowflake. So hopefully most of you know about the snowflake, and the snowflake is simply Wall Street's kind of snapshot of a company. It's really that's what it's meant to be. It's just meant to be a visual snapshot of a company, and it just helps you look at the characteristics, right? And so in this valuation axis, which is this top one, we're doing 6 different checks, which we're going to run through today, and that's what dictates the score on that axis. Okay, and I'm not going to go into Snowflake in too much detail. That's actually for tomorrow if anyone's interested. But the Snowflake looks at all these different factors, and it's just meant to be a visual snapshot. So this idea of a big green snowflake doesn't really mean anything. To give you an example, a company that pays a lot of dividends and also is growing is something that would be odd if you think about it for a second, because usually if the company is growing so much, why would they pay a dividend? Why would they not keep investing and growing? Now, just to make a point for anyone who hasn't seen this before, but the great thing about the snowflake is that we have it for every company, okay? So I can go to the whole US market. So I've just swapped over here. I can look at, for example, the US market, and we have that for every stock. So it's just meant to be that snapshot. And I can look through here and I can just see, like, these are obviously well-known companies, but I can just see the characteristics so easily. So something like a Tesla, obviously I can see it's not paying a dividend. It's not looking undervalued in any form, but it is expected to grow a lot. It's done really well in the past from earnings, and it's got great financial health. And that's all the snowflake's meant to tell me, and then I can go and dive in. So that's why the snowflake's really powerful, just as that snapshot. Cool. So now I've gone back. I'm back on Meta, and we're going to look in the valuation now. The most exciting thing about the analysis in the section, and why we're so proud of it, so happy about it, is something I just mentioned earlier, which is that value and growth are the same thing. And this is something that everyone gets caught on. Now, the best thing about this analysis is that every one of these checks is accounting for growth, right? So we're always trying to help you understand the relationship between value and growth. And we're looking at it in all these different angles, and that's why it's so powerful. So so let's get into it. Now, the first place we start might seem obvious to people who are a bit more sophisticated, but we're choosing the right metric, the right metric to use. Investing is just full of too many metrics, right? Too many different ratios and numbers and things like that. And the reality is, if you're going to value a company, the first thing you got to be doing is just choosing the correct metric for that company. We choose between 3 well-known metrics, which is price to earnings, price to sales, and price to book. Okay, and how it works is if the company is profitable, and sort of profitable, as you might say, in a sustainable way, we'll choose price to earnings. Okay, that's the most famous one. If the company is not profitable, we will choose price to sales, right? And a lot of the stocks that have crashed recently were being valued on price to sales because they were not profitable. And this is, that's why this is so great, because you can actually value those companies now. And finally, price to book is used usually for financial institutions like banks. But the way they're calculated is the same. Okay, so I'm just going to swap back to here. Cool. The way they're calculated is the same. Oh, my video is blocking the screen. That's annoying. Well, this is better than nothing, I guess. So let's use price to earnings as an example. The price is the same for all of those ratios. That is just the market cap of the company, or it could be the share price. The market cap and the share price, by the way, are exactly the same thing. The share price is the market cap divided by the number of shares that the company has issued, or the shares outstanding. And the earnings is how much profit that company is making, and that's always done on a yearly basis. So the P ratio is simply really the market cap divided by the earnings. So if I come back to here, and I go to P ratio, that's what this donut is simply visualizing for me. It's visualizing how much of the market cap is the earnings. And so if you look at different companies on Simply Wall Street, you're going to see like a huge range of these different donuts, because some companies you've got a market cap with a tiny slither of earnings, and others you've got the earnings taking up a huge amount, and that's really what the P ratio is. So really important bit to understand about P ratios, which really is obviously one of the most commonly used valuation measures. So the P ratio is good. It's the same. It's a normalized ratio, so I can compare the P ratio of two companies. But the challenging part is that a high P ratio is actually what you'd expect for a high growth stock. So the P ratio is actually primarily just driven by growth. So if it's a high P ratio stock, that's because the market expects it to grow a lot. And so you can have an undervalued stock with a high P ratio, and you can have an overvalued stock with a low P ratio. So this idea of just sort of obsessively just looking for low P ratio stocks, it's still a bit flawed, because like I said, value and growth are the same thing. If you're looking for low P ratio stocks, you're actually basically just looking for stocks that the market doesn't think is going to grow, which is fine, but you've got to appreciate that is actually what you're doing. So we've got the different ratios here, and you can switch between them. In the Others tab, there are some other ratios that some people do use. So the enterprise value ratios and PEG ratio, we actually can add more ratios here easily, so that if there is something that you'd like to see there, it's really easy to add. But really these three are the ones to focus on, because most companies can be valued on these three ratios, if you know what you're doing. Now I'm going to show you a little feature that for the more advanced users is quite useful, which is the forward PE. So there's a little toggle down here which I can switch on, and I can look at forward PE. Now, if you're just starting out and you're like, oh my God, PE ratio is already complicated enough, then for now just ignore forward PE. But forward PE, what it means is the P part, right? The market cap is the same, but the E part is now the earnings in 12 months time or 1 year's time. So technically it's a slightly better ratio, because now both numbers are future looking rather than the top number, the price, being future looking and the bottom one being historical, which actually doesn't make a lot of sense. But the forward PE is now using the earnings for next year. So it can be a better ratio once you understand it, but to be honest, you can still do the valuation just as well with the price to earnings ratio. And the earnings anyway, the earnings that the price is capturing are already years beyond next year. So it doesn't necessarily help that much, but if you understand it, it's really useful to know. And obviously we tell you what direction those earnings are moving, and I'll show you where we get that data from in a bit. So this is where we can see the key valuation, and that then leads us on to our first section, which I talked about a bit earlier, which is then comparing that ratio to peers, right? To the companies that are sort of close enough to that company. And so we automatically select the peers for you. And by the way, if you don't like the peers we've got, just get in touch with us and we'll improve them. But for now, we do the peers for you. And the most important part about this is this bit on the right, which is the growth rates, because like I said, value is all about growth. And so if a company has a higher P ratio, for example, like Amazon here, you would expect it to have a higher forecasted growth. And so just to make the connection, this forecasted growth number here that you can see on this right hand side is exactly the same forecasted growth number that you see in our future growth section. So for example, I'm looking at Meta here. It's on a P of 13, forecasted growth 13.5%, and 13.5%, that means 30.5% per year for the next few years. So if I go to future growth, I can see that exact number. So just so it's important to connect those up, that it's all coming from the same place, right? And so that 13.5% is actually the growth rate of this green line here, right? And you can see that here. So that's where, again, we have really good growth rates for these stocks, and that's what allows us to do this analysis really, really well, like no one else can. I'm just going to say I'm going to swap my screen over because I'm blocking it again. Okay, so I'm going back to valuation. I just moved to the future growth section. I'm going back to valuation. By the way, guys, any questions, just put them in the chat. and I'll answer them when I can. So, okay, so we're back here, and I'm going back to peers. So this is so easy because I'm simply comparing that stock to four other peers that are close to it, and it gives me that context about growth, because that's really what makes a difference, right? Now here I can see that if I take the average of these peers, I get a peer average of 31, Meta's on 13. That is way lower, and that's why we give it that one a check here, that score here for that snowflake, because it is way lower than those peers. Again, for the advanced users, you can toggle and look at the same data with a forward PE. Okay, so same data just with forward PE, which can be quite useful. And even though we've automatically chosen price to earnings as the best ratio to use to value this company, you can go here and you can change it, right, to price to sales or price to book. Probably for Meta, price to book wouldn't really make any sense, but certainly for a lot of financial institutions, if you're looking at valuing, say, a bank or an insurance company, it's actually price to earnings is still good to use, but you might want to look at both. So I can change to price to sales again, so I can just do those toggles. So that is the first part. We're simply comparing the stock to its peers, and that is the easiest way to value a stock. But the important part there is either peers ideally should be comparable companies, and they should ideally have somewhat comparable growth rates. And that, by the way, is always quite hard to do because no companies are perfectly alike. Okay, I'm moving on now to the next section. So we've just gone quite zoomed in. We've looked at the price to earnings ratio, and we've looked at it versus the peers. We're now zooming out, and we're going to actually look at the same ratio, but we're going to look at it across the entire industry. And so what we have here is a histogram, right? So a distribution of that ratio across the industry. And so for Meta, we're actually looking at the US effectively interactive media, so broadly kind of web media, and we're comparing it there. So what that lets me do, I can see where Meta's sitting. It's in this blue one here, but I can also go and move and navigate right into these different bands. So I can say I can look here and I can go show me all the really expensive US media companies. So I can actually click on this to pop it out to go to more detail. So to do that I just clicked on show more. And so say I want to look at that top band, I can actually go in here and I can see, well, of course there's, Meta, we know about that one, but I can see here and I can actually see Twitter, I can see IAC, I can see Bumble, and those companies are all on a way higher PE ratio than Meta is. So it lets you kind of see the industry kind of, I guess you could say, spectrum. And if I swap to another company, say like, actually the other company I was going to do is Snowflake, and I go there for here, now we're looking at the IT industry, which is a bit broader because it's harder to find an exact industry match for something like Snowflake. And you can now see that there's even more companies in here, and I can still navigate through each one and see which companies fit in there. And by the way, this can also be a great way to discover other stocks. Now, the same with this one, I can still go and change it. So we've defaulted to the metric that we've chosen, but you can still go override it and swap it over, and you can say, cool, let's show me price to sales, for example. Show me how that's distributed across the industry. So it's a really good way of just getting that visual snapshot of how the valuation of an industry is looking and which companies are in which part. Okay, cool. So next one, and of course the Snowflake check there is based on the average of the industry. So very simple, and it's actually a pretty useful way to think about it. Okay, I'm going to now cover the last bit for ratios or relative valuation, which is something quite new that I think will be new to a lot of you, which is called fair ratio. And so before I dive into this, I'm going to try and explain it to you first, and we're going to come back to it. Now, the fair ratio is also sometimes known. Oh, I'm going to swap my screen over so you can see it. There we are. The fair ratio is sometimes also known as the justified ratio, and it's actually not that common way to value a company, which is bizarre because it's quite logical and it's very powerful. As we said earlier, the ratio should be higher when a company is expected to grow more or is less risky, or the opposite. And so to calculate this fair ratio is actually quite simple. So sorry for the kind of math on here, but it's quite simple, because effectively what we do is we run something called a regression analysis over the entire market, and we use that to sort of back calculate if you will, the factors or the coefficients that you then need to apply to say, well, for a company with this forecast earnings growth, for this profit margin, and for this level of risk, what would be an expected P/E ratio for a company like that? Okay, and just to FYI, these are not the factors. I just made those up as the example. So again, if you're good at math, you'll say, "Ow, this does not add up." But anyway, so that's just to illustrate the example of how this works. So once you understand this, it's actually quite straightforward. But the simplest way to think about it is just that accounting for the company's future, right, the company's forecast earnings, right, the company's profitability and how risky it is, what would be a reasonable P/E ratio? And so we do that calculation. So that's why this is so good, because it accounts for growth. As we say, accounting for growth in valuation is actually one of the most challenging things. Now, just quickly, you might be asking, cool, well, this is great, but where do these numbers come from? Okay, and I'll just show you what those are so it's clear to you. So the first one, the most important one out of all of these is the forecast earnings growth. It is the future, the forecast of the future of the company. That number is exactly the same number that we saw earlier that I can find if I go to the future growth section. So it's really just that number there. Now, if I go back and I look at the profit margin, okay, this is like a little test. If there wasn't so much lag, I would try and test you guys here. But profit margin, hopefully you guys remember where to find that. I can easily find the profit margin here, right? I can see net profit margin right here. So the net profit margin you can just see in this waterfall, and that's really the the percentage of earnings from revenue. So profit margin can be found there. And the last one was risk, and the risk actually I can find up here. And the best measure of risk, or the sort of correct measure of risk, is actually to do with how volatile a stock is, right? How much the stock moves basically versus the market. And we actually do our own calculations on that. So stocks that are moving a lot would generally be considered more risky. And those are the three drivers that then we use to calculate this fair ratio. And we can then account for, say, hey, accounting for this type of company, it should be on a PE of this, but Paul, then are we watching new updates? Yes, these are new updates, Paul, but you can always go back and watch the recording. So that will give it more context. Now, so we got the fair, so that tells us what a reasonable P/E ratio should be for this company. And again, you can see here that from Meta's point of view, Meta's P/E ratio is 13, accounting for how profitable it is, how much it's expected to grow, etc. It should have a much higher P/E ratio. So it's a very easy way of saying this company looks actually quite undervalued, and that's why we give it, again, this snowflake score right here. Okay, so we've just finished the first bit, which is all to do with relative valuation, right, using ratios. Again, any questions, put them in the chat. We're going to do a Q&A at the end, so just collect them up, and if nothing makes sense, we can always go back through it. I'm about to move on to this part, which is intrinsic valuation, or what we'd simply call fair value. Okay, and before we get into this, for anyone who doesn't know, I'm actually going to start off with something very simple, which is the sort of premise of a discounted cash flow. So discounted cash flow to a lot of people can sound scary, it can sound complex, but the basic principle of it is actually very, very straightforward, which is simply to say, in this example, imagine someone said, I'm going to give you $100 next month, how much are you going to pay me? Now, I know that sounds like a silly example, but if I'm going to give you $100 next month, how much would you pay me for this? I'd probably pay you $100 because that's what's going to be worth, right? However, what if I was going to give you $100 every year for the next 3 years? How much would you pay for that? Now, the easy answer would be $300, but what if I said, well, I'm going to get all that money right now, okay? You're going to give me that money right now, whereas the money over the next 3 years, I have to wait to get that money. So actually what that means is I actually might value the money today up front more than the ones I have to wait for. So I'd actually discount it, okay? And to get really academic for that, you can take that even further. And so very simply, discounted cash flow is simply, it's going forecasting money, or in this case cash flows, into the future and working out what would be the present value of that today. And that's usually done by discounting it, and we're going to go into a tiny bit of detail on that now. So we could do an entire session, by the way, on this. So what all you need to know from Simply Wall Street's perspective is that we do it for you. And what is driving this? Okay, so what is driving the number here? And this is one of, we've had this in the platform for a long time. So what is driving this number? So this number is driven by our best estimate of the company's cash flows over the next 10 years and beyond. Okay, and we use two ways to do that, right? If the company has forecasts of cash flow, and to find the forecasts of cash flow, I can go to this section here, future growth, and I can go to this chart and I can actually turn it on. So you see there's by default, the chart, this one looks like this. I have the two kind of blue lines, but there's a free cash flow one I can turn on here. And so it's actually this kind of pink purpley line. I'm going to turn the other ones off. This is the line that we're using to then forecast out for the next 10 years and beyond to come up with that number. And I'm going to just show you the calculation in a bit. Now, what if there's no analysts? Because quite a lot of companies don't have any analysts, so there's no forecasts. If there's no analysts covering the company, then what we do is we kind of fall back. And now I've gone to the past section. So past section is all historical company financials. So I've gone to the past section, and again, I can turn on the same thing. I can turn on free cash flow. And so now this is the one we would use in a company that didn't have any analyst coverage, so it didn't have any forecasts, right? Generally, most popular stocks will have coverage, but there will be some that don't. Now, that's what's driving this number. Okay, so we're using that data and we're then doing a discounted cash flow, and that's how we're arriving at this number. And for some people who may have noticed, this number can actually move around quite a lot. It can move around quite, especially for the smaller companies. Why is it doing that? Okay, it's moving around often because there's analysts covering the company, and they are actually changing their mind on where they think the cash flows are going to go. And because as that moves, for some companies that can be very sensitive. And so that sometimes what happens is an analyst changes their mind, and that can substantially move this fair value. And sometimes you will see it move from a high value to a low value overnight, and that's usually what's driven it. So if you want to learn more about discounted cash flow, the easiest way to do it is to click on this button here, which is data, and we then have the entire calculation here for you. So if you're someone who does want to go and learn this, then you can use this calculation to learn it. And we also have documentation. So if you click here, we can go to the analysis model. Actually, sorry, if you go learn, you can go here, and we have all the background to that, and you can go and basically learn how to do it. And like I said, the great thing is we give you this full calculation, so you can sort of start to, as you learn, step through it and use this as a guide. Now, again, doing a discounted cash flow takes a long time to learn. I think it's worth doing if it's something you want to learn. And I'm going to also show you quite a cool tool that we built that was slightly experimental afterwards for people that are interested. But if you're just starting out at investing, I would say you don't need to worry too much about learning this area. All this whole check here is telling you is simply, yeah, guys, I will save the stream, don't worry. So all this check is telling you is simply saying, cool, based on the company's cash flows, of the forecasts of cash flows, what would be a reasonable value? Okay, and like we said earlier, this is only really one way of valuing a stock. So it's not like if every stock was perfectly valued on cash flows, things would be a lot easier. But that isn't the reality. So that's really all this is telling us, is just saying based on the forecast cash flows of a stock, this is a reasonable value. And if it's undervalued like this, then that's usually a good sign. But like I said, you still need to think of your narrative for the company. Like you still need to think of what is behind it. And you don't really, that's really all this is meant to do. Just quickly, some people will ask, what's the difference between cash flow and earnings? I won't go into the details of that. I guess the short answer is, in the long run, the two usually align. Okay, you can use earnings if you want in a discounted cash flow. It should technically be cash flows academically, but broadly speaking, you can use them interchangeably. They do, obviously there's a difference, and it's something that should be accounted for. And in Simply Wall Street, we do have both cash flows and earnings. So like I just showed you in those charts, I can look at both of those. So this is our fair value. And again, I want to stress one thing before I move on, that the really powerful thing about the analysis here is that the data behind this fair value and what we're using to arrive at this number here is completely different to what is going in here. They're not connected whatsoever. So they're two completely separate measures of a stock's valuation, and that is on purpose because we want to look at those different ways of doing it, those different factors, right? So, yes, they're in the same section, but they're completely different. So a stock could be undervalued on one and overvalued on the other, or both. And so I just want to kind of highlight that they're completely different. And the great thing is, like I said, they are both accounting for growth. That's super important. This one is accounting for growth, looking at the forecast earnings and then looking at that regression model. This one is accounting for growth, looking at forecast cash flows and discounting them back to today's value. So they're different. Simon just asked a question, which is a very important one. What discount rate is used? Good question, Simon. To find the discount rate, you can click on data and you can actually see it here. So discount rate here is something that we've calculated. And again, we actually go into the detail of the process we use. So if you go and learn about doing that, you'll recognize it here. One little tip I'll give you, which again can be confusing when you're learning this stuff, which is there's two types of discounted cash flow, and the one that we are doing is using what's called levered cash flow and something called cost of equity, right? And that's actually the right discounted cash flow approach to use when you're valuing stocks. There is a discounted cash flow that can use a weighted cost of capital and something called unlevered cash flow. I won't go into the detail, but that is what you use to value an entire business and also include the debt. So if you were sort of doing M&A or something, that would be the approach you'd use. The problem is the two get confused, and the weighted cost of capital adds another level of complexity. You don't need to worry about that. Just worry about cost of equity if that's what you're doing. Okay, we're going to move on. So last part. Okay. The last part we've added is analyst price targets, right? As you guys know, you've got analysts covering the stocks, but the reality is that those analysts, how do we put this politely? The data shows that only 51% are correct, right? So they're not necessarily correct or not correct. The reality is, and I just love looking at this chart, and I'll tell you how to read it in a bit. So what this chart is telling us, you've got the dark blue line here, which is simply the share price, and you've got the purple line, which is the forecast. And the forecasts that the analysts make for their price targets are 1 year generally in advance. So they're kind of saying, I think the price roughly will be this in a year. Of course, it's not perfect, but that's roughly how it works. And what you're going to see for most companies is that the analysts are basically following the price of the company, right? So you can see here that the two kind of just look like the same but offset, right? So that's why that's why it can actually be a bit funny to read, because the analysts are often just adjusting their prices. So as I move, I can see going forward what those differences are, and that's what that line's telling me. And if I look at today, that has actually changed a bit, because now I can see that the analysts actually are expecting a much higher price, right? Their consensus. So if we look at 49 analysts, you can see that here, 49 analysts covering Meta, their consensus is actually quite a lot higher than the current share price, right? Now you might think, cool, that's awesome. That's an easy buy. And we would actually say, well, that isn't the whole picture. So what we've gone and done is a bunch of research on what factors can you use to look at whether these analysts are actually successful, whether there's actually much confidence. And we've actually found the factors that can be used to determine that. And it's actually something as simple as how in agreement the analysts are. So if you have a wide range of analysts and they all think different things, right, that usually means that the price targets, there's not much confidence there and there's not much success. So what we use is, you'll see here that for Meta, the price target is way above the stock price, right? In fact, it's like 40% above the stock price, but there's very low agreement from the analysts. And so we're not actually going to give it that snowflake check here, because to get that check, you've got to have the price 20% higher and the analysts have got to be in agreement, right? Or to statistically confident amount of agreement. And only then really can you say that it's confident enough to say that the analyst targets is meaningful. But in any case, it's great because you've got a whole nother data set here of valuation of effectively the analysts. We're doing the analysis for you to look at, to look at what's driving that, and you can also see how they've been changing. So it's very, very powerful way, I would say, just to see how that consensus has moved. I'm trying to think if I've got a slide on this or not. No, I don't think I do. Okay, cool. So I've just gone through now every different step of that new valuation analysis, and just to remind you guys that the checks there are the 6 checks that are driving the value axis of the snowflake here. Now, before I stop and we're going to go to questions, what we'll do, I'm just going to say touch on 2 more things. So the first one is this valuation is all well and good, but you guys don't want to have to keep coming back to this all the time to check on it, okay? And so what I'd recommend is for any stocks that you're watching or you're thinking of buying, and of course any in your portfolio, you should be adding them to your watch list. And why is that? Because once they're in the watch list, and I'm going to go to the watch list here, so to add them to this one's already in my watch list, I've already done this, but just click here, add to watch list. And what does that let me do? So if I go to my watch list, so the first thing it lets me do is get updates on the stock, right? And the updates that we do are completely unique to any other platform you're going to see. Most other platforms or brokerages, the updates you're going to see, they're just full of trashy news and noise. They're not really that meaningful. So ours are very focused on kind of what we like to think of the important aspects of what's changing with the stock, things about the fundamentals, things about the management team, and of course, like I said, when the valuation changes, we'll update you. So you're going to get updates on the valuation when you follow it. So that's very useful. But there's one other thing that we do in the watch list that it's really going to help you guys as investors to get into that mindset about how to use valuation to drive your decisions. And that is actually the ability to set your own fair value for the stock. Okay. So I might move my screen over so you can, there we are. Okay. And so that's something that's kind of unique about this watch list is I can now set my own fair value. So I can go in here, okay, and I can click set, and I can enter my own price, right? And so, like I said at the beginning, really that's how you should be investing. You should be saying, what do I think this stock is worth? When does this stock become interesting to me? And that's the number you can put there. It doesn't have to be super accurate unless you want it to be. And that's what drives your decision making. And I know it sounds simple for me to say it like that, but that's really the right mindset to be in. Now, if you don't have a fair value, you can use our value from our discounted cash flow, the one I just showed you. You can also use the value from the price targets, also the one I just showed you. But there's also one other place that I can use to get this, and that's a little tool that we built. They're going to show you in a bit. So setting this price target is a really great way to stay in touch with the stock and also to get yourself into the mindset about how you should think about driving your decisions. So let's say it's Atlassian. I know they've gone down a lot, but let's say I actually think Atlassian now is worth, say, 250, right? Save that. Now, okay, this seems silly because I've just put in a price target or my own valuation of 250 and the price is lower. What does that mean? If I really believe in that and I believe in my narrative, I should be buying that company because that's what I believe, right? So whereas if I put a price target below that, then I just got to sit there and be patient for when the stock is going to hit that price. Okay, so what is this exciting thing I'm going to show you now? This first of all is a bit more for probably the more advanced investors, but of course anyone can play with it. And it's a tool that we built to help you value stocks, right? It's called the Stock Valuator. I'm going to show you how you can find it in a bit. It's a little tool that just helps you get a feeling for the stock's value, okay? And you can access it in 2 ways. You can either get it via your watch list, and so to find it via the watch list, you actually have to set a value, and you see here it says use valuation calculator, and I click on that to get to it. You might have noticed that it didn't exist for no, I didn't enter a value there. It didn't exist for Atlassian, and I don't think it exists for something like Roblox. Why is that? Because this tool only works at the moment for profitable companies. So if a company is not profitable yet, unfortunately, this tool doesn't work. So So that will be why you don't see it. But if you can get to it anyway, if either through the watch list, or you can get to it up here and you can go beta lab. Okay, and you go into the beta lab, and I can also get to it there. So you can always get to it in that route. It's also a Chrome extension. I won't talk about that. So that's how you can get to it. So I'm just going to quickly show you how that works. So I'm in here, and I use the same company. I'll use Meta. So search for the company, and what this tool is doing is it's actually doing a discounted cash flow in the background, but it's now allowing you to play with the inputs, right? So Simon will like this because he asked about the discount rate. But like I said, really the main input you need to worry about for any discounted cash flow is actually the growth. Like I said, that's what drives the valuation. So that's really the main input. We actually start off by back calculating the growth. And so you can see here, we've back calculated it for today's price to 6% a year. So if I move that growth slider, I will change the share price of the company or my valuation. So that's the easiest way to think about value, and that's the annual growth rate. So that's, again, that growth rate year on year on year that I think that company is going to achieve. And the way this works is it does that for the next few years, and then it tails off over time to something that you can set here. So if you do want to get advanced, which maybe Simon or someone you might want to do, then I can go in here, I can play with my discount rate. So if I see here, if I increase my discount rate, which is me saying the stock is more risky, then the valuation will go down, and I can change the other inputs there, which I won't go into in detail, but I'll let you explore it. Just one thing that might seem odd, if I click view calculation, that is not connected up. So it does give you a calculation, but it won't give you a calculation for this company. So have a play around with that. It's really fun, and like I said, it's a really easy way to explore the valuation of a company. So that's awesome. Now, I think that's pretty much it. I think I've covered everything. I think next is Q&A. Just before I go into Q&A, I'm just going to sort of make one more example for you guys. Now, the example I'm going to give you, which again is something that we always found hard for our original analysis on valuation on Simply Wall Street, is it originally didn't work very well for companies that were loss-making, right? Companies that are loss-making, you can't use the normal metrics to value them. And so that becomes really, really hard. And especially, well, not so much now because they've all dropped in value, and I think only the profitable ones are going to survive. But anyway, so when a company is loss-making, it hasn't got any earnings yet, but that doesn't mean the share price isn't expecting earnings in the future at some point. So for a loss-making company, you kind of have to end up using a price-to-sales ratio to do that, okay? So again, for this, I'm using Snowflake as an example. By the way, this company had a crazy price-to-sales ratio back, before the sort of tech bubble burst. Now it's a bit more reasonable at 33x. But again, we've defaulted to price to sales because price to earnings isn't the right one to use. It's a loss-making company. We've defaulted to price to sales here. You can still do forward price to sales if you want. Like I said, I won't go into detail there. So we're starting with price to sales, but the great thing about this is every part of this analysis still works for this company. It's a loss-making company, but you can still value it in exactly the same way, and that is just incredible, right? So here again, now you'll notice that we've actually changed the earnings growth for sales growth, because again, that's the best you can kind of base it on. Your earnings growth probably isn't meaningful yet for these companies, but again, a company with a high price to sales, so a company that's expensive, you would expect to be growing really, really fast to justify that. And that's really, again, what I can see here. So you've got Snowflake compared to companies like Cloudflare, but Snowflake is expected to grow faster than Cloudflare, which kind of justifies why it has a higher valuation than Cloudflare. So again, this works perfectly for a loss-making company. Of course, comparing to the industry, that works fine as well. Admittedly, Snowflake is definitely on the expensive end. The fair ratio, again, that works fine. So we can still calculate a reasonable price to sales ratio considering those factors for this company. Discounted cash flow, that works well. Now, again, that's the best thing about this discounted cash flow is a company can be unprofitable now, but it can become profitable in the future, and we can still use that to calculate the fair value. So you will still see, even for loss-making companies, often if we can get the data, we can still come up with a fair value for that company. Again, that's really, really powerful. like I said, I can actually dive in here and I can explore what's driving that. So I can see here that actually the free cash flows are, I think the company is already just free cash flow positive, but it's expecting to grow, and that's what's driving again that discounted cash flow here. So it's so powerful to be able to do that for these companies. And finally, analyst targets. Of course, they're going to work for any company. Um, so so every check on here works for a loss-making company, and that's something that we're really happy about. So John, yeah, does it automatically default to price to sales? Yes, it does, and that's the idea. So remember that John, you might be looking at two companies, two different snowflakes. One might be using price to earnings to do all those checks. One might be using price to sales, but the checks are the same. Like the checks versus the peers or versus the industry, or they're the same. It's the same premise, but the ratio we've used is different. And again, that's so powerful because it still means that the snowflake is meaningful for both those companies. So cool. Like I said, once you understand that, it lets you kind of appreciate that axis of the snowflake more, and you can use that in the screener. So again, if I'm in the screener, I can say I'm going to go to US because I figure most people are there, but I'm going to go US only. So I'm going to switch on US, and I'm going to say, okay, well, I actually just want companies that are, maybe not crazy undervalued, but I want to have some measure of value. So I might drag that to somewhere in the middle. And so that's going to filter out some of those companies. So that means that all of these companies, out of those different methods I've just shown you, they're undervalued on some of those aspects. So I can obviously go harder. Remember that if a company is very, very undervalued, then it could be too good to be true. So always something to consider. But then I can start to say, okay, well, I also want a company that's going to be growing a lot, and I want one that's in a really good financial position. And so that lets me so quickly just drill down into companies that might fit that. Now, of course, that's what I've just done is looking like a lot of the tech companies. I can actually filter those out if I wanted. So I could actually, I could add industries that I like. So anyway, this is a screener. We could do a whole other session on this. But yeah, so that's super powerful. I'm gonna leave it there, and I think I'm gonna take some questions. So please, guys, I go back to my Q&A. Look at that. Yeah, please shoot. Send me your questions. I think there's about a 30-second delay, so sorry for that. It'll take me a bit of time to get your question, but ask away. And we've got some time left, so we'll get to some questions. Okay, so first question from our friend in Africa or South Africa. Will we ever see a Simply Wall Street API? Yes, actually, that is something you might see. That is something that one of the teams is looking into. And I'd be interested to know how you would go about using that API. That would be useful for us to know. Michael saying, ironically, Meta fits into the Ben Graham formula. Yes, so yeah, I would say with all these formulas, like I said, I think it's so important to not be tempted to use these kind of one line, sort of quick valuation type formulas, simply because they're always making concessions and they're always just way too simple. In fact, I know the Ben Graham formula, and the Ben Graham formula is trying to be a proxy for growth, right? That's really what it's trying to do. But if you understand the kind of what's driving all of these things, you can just make so much better decisions. So I'm getting a lot of interest for API, so that's good to know. Keep that in mind from also from John. But yeah, tell me how you would use it. That's what I want to know. All right. Any other questions, guys? If there's no more, I'll wrap up in a bit. But yeah, anything else you guys had questions on? Of course, this stream should be online on YouTube after we finish, so you can just go back and watch it. And if you do have any questions anyway, you can always reach out to our support team. They're online 24/7, so they'll always help you with any questions you have. And of course, I think everyone here will know, but Simply Wall Street's it's always free. So Um, uh, so you don't all the data I've just shown you, you don't need to be paying to have that. You can get it for free. So um, okay, I think I see where the API is going. um, Finance Mark saying an API. We're getting a lot of API requests. Okay, so that's good to know. um, okay. Do you guys read the report to get your data? That's from Amit. So Amit, the data on Simply Wall Street is coming in from it's coming in from a data provider. So we ingest all this data in. The data provider is actually a company in the United States called S&P, and so so we put all that data in, and then we run our own analysis to generate our insights on it. So it's not being done one by one; it's being done using a system. So we have a team of analysts at Simply Wall Street, but the team of analysts, what they're actually doing is helping us create the systems that do that for us, and that's how we're able to cover every stock in the world, right? It just wouldn't be possible to cover every stock in the world by manually reading all the reports. So, okay, excellent. Well, look, hopefully that was useful for everyone. And like I said, if you have any more questions, then just hit us up, and we're always here to help you guys. And if you have any other, okay, actually, this is what I want to finish off with. What type of webinars would you guys like to see apart from an API webinar? But apart from an API webinar, what kind of webinars would you like to see that we can dive into, because that's what we want to get inspiration from. Sam is asking, how often is the valuation updated? So the valuation is updated, all that report is updated every day. So it's being refreshed every day. And just remember, though, that the main data that's actually changing is the price. That the price is changing every day. So the data that changes the most in the valuation is actually the price and the analyst's forecasts, right? Those are what really change. The earnings, of course, only change generally every quarter. Jordy's asking, can we please embed the stock valuator in the main stock view? Yeah, that is something we're considering. Definitely, that's it's a tool that we built to experiment with, and it's something that we might be doing. Our South African friends asking about short-term trading. Unfortunately, Simply Wall Street is a platform specifically designed for long-term investing. And so, yeah, we don't try to sort of complicate it with anything short-term. It's totally fine if that's what you want to do, but Simply Wall Street is really designed for long-term investing. That's what we're here for. So, okay, guys, I'm going to sign off. I'm going to stop the stream, but thank you so much for attending, and hope to see you soon.